I think we'll go ahead and get started. Thank you, everyone, for joining us. Welcome to the latest Duke Media Briefing. I'm Greg Phillips with Duke Communication. Inflation in the US is at its highest in 40 years. The US Federal Reserve has increased interest rates by 0.75%, the largest single increase since 1994, in hopes of slowing the increase in prices for food, fuel, and other staples. We have three Duke economists with us this morning to discuss the outlook for the rest of 2022 and beyond. With us today is Emma Raziel. She is Associate Chair and a Professor in the Department of Economics at Duke and Teaching Director of the Duke Financial Economics Center. Also joining us is Connell Fullenkamp. He is a Professor of the Practice and Director of Undergraduate Studies in the Department of Economics at Duke. And we have David Berger. He's an Associate Professor in the Department of Economics at Duke, where his research interests include housing, labor, and finance. Good morning to you all. Professor Fullenkamp, we'll start with you. What effects do you expect to see from last week's interest rate increase? And do you think those effects will be the ones that the Fed was expecting or hoping for?
Well, certainly we'll see interest rates continue to increase. They've been increasing really throughout the spring, and the 75 basis point increase in interest rates is certainly going to continue to contribute to that. What the Fed wants to see is solid evidence that inflation is slowing down and the economy is cooling off. And I'm afraid the Fed is going to have to wait a lot longer and continue to raise interest rates before they see that. I really see this as kind of the summer of the last hurrah in terms of consumption, because we still have a lot of families who have leftover money from the pandemic, fiscal stimulus packages, and a lot of people have pent up consumption demand. They want to go out and take that summer vacation. They know the prices are increasing. So you put all those things together, and a lot of people are going to say, let me go out and spend this extra money that I have before prices go up too much. So I think the Fed is going to have to wait a little bit longer to see significant evidence of the economy cooling off from its actions.
Absolutely, thank you. Certainly more to dig into there, and we'll come back to that. But for now, Professor Berger, we'll move on to you. House prices were already rising before the pandemic and this subsequent wave of inflation. What do you expect to see from the housing market here in the Triangle and nationally for the rest of 2022? And what are the factors that are driving that?
Well, as Professor Fullenkamp mentioned, interest rates have gone up substantially. So I suspect the housing market will cool somewhat relative to what it's been like in the last 2 or 3 years for sure. But for the Triangle specifically, I would be quite surprised. I mean, it definitely will cool, particularly at the top end of the market, but I would be quite surprised. It's going to be more of a modest cooling, because I think it's important to remember we've had sort of record low housing inventories still in the Triangle. And moreover, nothing about sort of the underlying demand. Many people are still moving here, supposedly 15 households a day to Wake County, 5 to Durham County. And that kind of increased demand. So I would expect to see fewer bidding wars probably, but some price decreases. But I would be surprised if house prices fell substantially here, just given the underlying demand factors. But for sure, the fact that mortgage rates have gone up, I mean, average payments are at least 30% more expensive than they were a year ago. That is quite substantial.
Absolutely, it certainly is. And I've got more questions on that. We'll come back to it. For now, Professor Raziel, I'd like to move on to you. Housing is obviously, a house is the biggest investment that most people ever make. But what other areas of the economy do you expect consumers to see a pinch in particular through the rest of this year with inflation?
We're certainly expecting that the gas prices may continue to stay high. And, for that's the most noticeable price increase for all of us, I think, because especially since, we fill the same size tank every week. So we know fairly precisely how much that's gone up by. And it has gone up. It went up 50% last year. It's gone up another 50% this year. That may continue to stay high. Food is the other big issue in terms of pricing. We've seen meat prices in particular go up a lot. Fruit and vegetable prices have not gone up as much for various reasons. But I think over the course of this year, we may see those other fruit and vegetables going up in price as well, because there are constraints on access to fertilizers, which is really affecting the production cycle.
Absolutely, thank you. And thank you to all of the panelists for those opening remarks. We will open it up to questions now. Thank you to everyone who submitted questions in advance, and we'll tackle those first. You can also post questions via the Q&A window at any time. And if you'd like to ask a question in person, raise your hand in Zoom, and we'll unmute you when your turn comes around. If you're calling in by phone, you can raise your hand by pressing *9. And thanks also to everyone watching on YouTube. For now, Professor Raziel, I'd like to stay with you on this topic of gas. President Biden has proposed a federal gas tax holiday. Could you talk a little bit about about how that would work and whether it would make a substantial difference to consumers or to anything else if it's actually enacted?
So if there is a gas tax holiday over the summer, which has been suggested, I think the numbers are something like 18 or 20 cents a gallon. What we have to keep in mind is it's then up to the gas suppliers to decide how much of that to pass on to consumers, because it's the providers of gas are the ones who get that break. Maybe they will pass on 8 to 10 cents to consumers. Overall, I think it's a fairly small impact, maybe, $1, $1.50 less in the cost of filling your tank on that occasion. So I don't think it'll make a huge difference, honestly. I think it's more of a PR exercise than anything else.
Sure, absolutely. Thank you. Professor Fullenkamp, moving on to you, but staying on this similar topic, we've had a question come in asking that whether we should expect gas prices to continue to stay high or escalate, because we are proving that we will continue to consume gas. Obviously, it's an essential thing. We've seen gas prices fluctuate a lot regardless of what's going on elsewhere in the economy. So is that something that you expect to ease off, or is inflation going to carry those prices ever higher?
I think inflation is going to carry the prices higher for a couple of reasons. One of what you just mentioned is that people are really dependent on their cars, and it takes a very long time for people to adjust their lifestyles. And a lot of people really can't. You really can't just pick up and move, especially these days, as Professor Berger said, because you want a shorter commute or something like that. But the real story behind gas prices is actually refining capacity. So gas prices have gone up a lot more than we've seen when oil prices have gone up by this much before. And it's because during the pandemic, a lot of refinery capacity was shut down, and those refineries are so old that the companies that own them don't want to restart them. They're either too inefficient or too unsafe to restart. So we're seeing a lot of gas price increases because of lack of refining capacity. And a new refinery takes a long time to build. It's very expensive. It is not clear that we're going to add any refining capacity in the short term in the U.S. And so I really think that's one of the big things that's going to contribute to gas prices continuing to rise.
Thank you. And before we move on from the gas issue, obviously we're starting to see, Ford introducing an electric pickup truck, and there's obviously some momentum around electric vehicles. Obviously electric vehicles are also very expensive. So with the current inflationary environment and the pressure on gas prices, do you think that could accelerate a move towards the electric vehicles, or the fact that they're so expensive in an inflationary environment means we wouldn't necessarily expect that to hasten?
Yeah, well, certainly a lot of people I've talked to personally have mentioned that, and I think there's a lot of aspiration out there to move to electric vehicles. But again, it's such a small part of the market right now. It's only in the single-digit percents in the U.S., and we're stuck with, just like everything else in the supply chain, limited capacity to expand production. So even if all the people who wanted to purchase electric automobiles and had the money to, we really have a limited capacity to expand production of electric vehicles at this point. The scramble for resources to get all of the raw materials to build the cars, all the lithium to build the batteries, that's going on, and it's far from clear that we're going to have enough of those resources to expand supply very quickly there either.
Sure, absolutely. Thank you. Professor Berger, I'd like to come back to the housing topic. We talked a little bit about the triangle here in North Carolina, which of course is an extremely hot market. And I know that all real estate markets are ultimately local, but when you look across the country and maybe looking beyond cities where it's particularly hot because of the kind of tech boom that we've got here, when we talk about the market cooling off, would you expect to see house prices drop at all? Or do you think even in these calmer markets, ultimately what we're just looking at is maybe prices to rise a little bit more slowly, but they're not going to be actually dropping?
So I think there's significant uncertainty about that. And obviously it's going to, as you said, all housing markets are local. It's going to depend a little bit on the housing market. But I think that the right precursor is to look back to housing markets in the early 80s, where, we had a large increase in interest rates under the Reagan administration. And I think there we saw house prices fall pretty soon because of payments. My mother, bought her house in Atlanta in 1981 and was paying a 16% interest rate. I don't think we're going to go there. But I do think it's not unreasonable to expect prices potentially to fall 5-10% in many markets around the United States. There's a lot of nice work suggesting, for example, that for every percentage point increase in interest rates or mortgage rates, that mortgage demand, or how big a mortgage one gets, falls a couple of percent. So we've already seen 3 percentage points, so that's 10%. So it depends a little bit about each of the housing segments. As I was saying before, I expect like the higher end of the market to go up. I mean, it's much more expensive, for example, to buy $1 million house than it was before. And as we know, and there's more and more of these, in California, I was in California all last year. There were many $1 million houses. That's very expensive at 6%, much cheaper at 2.5% as it was a year ago. But so, as I was saying, I could see housing prices moderating. My expectation would be for here, they moderate. Last year, housing prices in Durham and Raleigh went up 30% at least. That's not going to happen again. I would be shocked. I think much closer would be, below 10%, 5%, something like that. But, it wouldn't be, if rates keep going up, if the Fed's going to keep raising rates, they've made that clear until they get inflation under control. So as rates go up, I could easily imagine, house prices could fall a little bit. But my median expectation would be that they rise, but much more slowly than they've been in the past, more along historic norms. As I was saying before, there's still there's very little housing inventory available in the triangle. And that just suggests that there's just not a lot of supply. So even if demand cuts back a little bit, there's still going to be people, house prices there's still room for house prices to go up.
Absolutely. Thank you. And to kind of transpose that question to the rest of the economy, one of the questions that we had come in, which sounds simple but is profoundly important, I guess, is that inflation obviously is not just the increase of prices, but the rate at which prices are increasing. And some people are asking, would we expect prices to ever actually come down again for food, and for these other staples? Or when we reach these plateaus, it's just like, okay, the prices will plateau, but this is what we're living with. They're only going to continue to increase over time. Professor Raziel, is there any prospect of the cost of these basic things that are currently skyrocketing to ever come back down?
Oh, absolutely. And in fact, it is the more volatile prices in markets like, for gasoline, for food, that do actually see price drops when things calm down. So it is by no means unheard of to see the price actually fall, not just stop going up, but actually come back down again. And in fact, there are times where we see this across the whole economy at large, although it varies tremendously sector by sector. But I mean, we can all think about the sort of cyclicality of gas prices because we're all very sensitive to it. Back in 2008, gas prices were at $4. 5-6 years later, it was down to less than $2 a gallon. Now it's back up again. Same applies for food. So those markets where the price is most volatile are also the markets where we do actually see prices fall under the right set of circumstances.
Okay, I'm going to choose to take that as a shred of hope. Professor Fullenkamp, similar, somewhat related question. You mentioned earlier about this possibly being the last hurrah of spending for people that had reserves from the pandemic. Do you think then that, how long would you expect that hurrah to last? And then once that spending drops off, could that actually help accelerate the end of this inflationary environment if spending does kind of drop off?
Yeah, I think that's one of the big questions that a lot of economists have coming out of the pandemic. Who has extra money and how are they going to use it? And I really think that, by the end of the summer, most of the families who have extra money, who are willing to spend it, who didn't just sock it into savings, for example, are going to have spent that, and I think that could potentially start to help cool the economy down. One of the realities of using monetary policy to fight inflation is that it just takes a long time. Monetary policy works through the banking system. You have to wait for people to stop borrowing, and so it just takes a while. And I think this is also part of that. We have to get through this kind of overhang, if you will, of extra money laying around for the pandemic fiscal stimulus package, and that has largely worked its way through in kind of the lower end of the income distribution, and kind of the middle is going to pretty much spend it up, I think, by the end of the summer.
Absolutely. Thank you. Professor Raziel, I'd like to bounce back to you, but I'd like everybody's perspective on this if you can offer it. Professor Fullenkamp was just saying that affecting the economy through monetary policy takes time. Is there anything else that policymakers could or should be doing right now to cool this environment? Are there other tools in the toolkit that they have yet to use?
So my personal view is that I would actually swing that question the other way around and say, how sensible is it for a number of different policies to be experimented with, and whether the best thing to do is to go with the monetary policy that has been used for decades, that as Connell said, takes time but will work over time, whether it's better to just sort of focus on that and not keep trying other things, in particularly something like, the tax holiday on gasoline and so on. Those are short-term effects. They may affect consumers less than the government intends. They may just end up being beneficial for the gas companies. What we need to see is, as Connell said, that money that's been swimming around in the economy because all the fiscal stimulus, we need to get that sort of largely spent so that the economy can then sort of settle down and go back into a pattern that we understand better.
Sure, absolutely. Thank you. Professor Berger, I'd like to come back to you. Obviously, the Great Recession wasn't all that long ago, and we saw waves of foreclosures. We saw people upside down in their loans. Obviously, lenders have become a lot more circumspect as a result of that. But with the kind of prices and the kind of increase in costs that we've seen, would you anticipate, another wave of people, even if not foreclosures, people ending up kind of upside down in loans and trapped in mortgages that aren't necessarily in their best interest? Is that something we should be bracing for?
Good question. Well, first, I just want to reiterate what Emma was saying. I would agree. I think a lot of these, President Roswell is correct. Like a lot of these policies that they're talking about, gas tax holidays, are kind of putting just a Band-Aid on the issue. The issue is that there's just a lot of supply constraints, and we had unprecedented fiscal stimulus, which was good in the sense that we learned a lesson from '08, which was we weren't going to accept, 6 years of below trend growth. We may have gone a little bit overboard, and it's very, these are macro tools. They're very difficult to fine tune, but now the consequences of that is that we have to raise interest rates for a while to get inflation under control. I mean, the Fed has a dual mandate. They have to care about inflation and maximizing full employment. To your question, so lenders, economists are very good at learning lessons from the past, or the near past, I guess. That's a better way of putting it. So we learned that we needed to have better underwriting standards. So the good news is, underwriting standards are much improved. So we it's much more difficult to get a loan if you're more risky or more likely to unable to be default in the past. And so in that sense, I'm pretty sanguine. We're not going to see a lot of foreclosures. Many people also who've purchased recently, experienced extremely large equity gains or cushions that they are going to be able to tap. Now, of course, it's very expensive to do a cash out refinance now right now because that would functionally giving you a new mortgage, and no one wants to go into a new mortgage. So in that sense, I think a lot of households have a lot of cushions, and moreover, because of that, there's quite a bit of, because house prices have gone up so much recently, households have much more cushions. They're much more able to weather these, like whatever moderate price falls that might happen. So no, I'm not particularly concerned about foreclosures. But that said, you are seeing some warning signs. You've seen the fraction of households moving into ARMs, adjustable rate mortgages, away from fixed rate mortgages has gone up, which suggests that people are trying to figure out ways to purchase homes in ways that may be more, potentially risky down the road. So it's definitely something to monitor. But I would say the vast majority of people, have a capital buffer to ensure in a way that we did not have in the Great Recession.
Absolutely. Thank you. Professor Fullenkamp, coming back to you, and again, I'd like everybody to weigh on this if they want to. The Great Recession isn't that far away in the past, and we're seeing this inflationary environment that's often followed by higher unemployment and potentially a recession. Is that something that you anticipate, that we could be headed for another recession and higher unemployment simply as a result of the inflationary environment we're in, or is that not inevitable?
Well, inflation doesn't necessarily lead to recessions by itself. What really tends to push the economy into recession is the monetary policy actions or the other policy actions taken to try to restrain the economy and cool it off. And, as Professor Berger suggested, this is a really hard balancing act. The Fed wants to cool inflation off. In order to do that, you've got to get people to borrow less and consume less. And of course, if they do those things, that could tip the economy into a recession. So the Fed's goal all along has been to achieve the so-called soft landing, in which they slow the economy down, but growth continues maybe at a very slow pace, less than 1%, but it's still positive, and we don't throw a lot of people out of work. Now, because the Fed has waited so long to really get serious about raising interest rates. They have to raise interest rates faster and by a much higher margin. And those things tend to decrease the probability that we can have the soft landing. So personally, I'm thinking that our economy is going to tip into a recession probably early next year. The good news is that it's probably going to be a fairly mild recession, given the strength that we've seen from consumption, given the fact that, as Professor Berger suggested, households are not, they haven't overborrowed like they did before the Great Recession. They're actually in pretty good shape, partly because of the stimulus package and partly because of the employment picture has been so good for a few years. So between those things, consumption, which really powers the economy, I think is going to remain robust enough to keep us out of a real deep recession. But we could see unemployment go up by a couple of percent in the first part of next year. But again, if we put this in perspective, unemployment going up from 3.5% to 5.5%, it really isn't terrible. Of course, it's terrible if you lose your job. But in the grand scheme of things, if we look back to previous recessions, unemployment has gone up to 6, 7, even 10% before.
Sure, thank you. Professor Raziel, what's your perspective on that question and on Professor Fullenkamp's take on it?
Yeah, I agree with what Connell was saying. Absolutely. One of the key factors, as you mentioned, is households don't have excessive amounts of debt. And when there are excessive amounts of debt, that's when we can see recessions really cause a problem and see unemployment go up a lot, because as people are unable to make their debt payments, that ripples through to all the people who aren't getting those debt cash flows that they should be getting. So without over leverage, without too much debt in the system, if we do go into a recession, and I agree with Connell that we probably will, I don't have a sense of when that will be, but I do agree with him. It will be not too bad of a recession. And yes, if we see unemployment go up to 5%, 6%, maybe 7%, I don't imagine it will go back to the double digits unemployment that we saw during the Great Recession in 2008.
Absolutely. Thank you. Professor Berger, I've got some more housing questions for you. And one very blunt one, as you've mentioned, with the Triangle is a very hot market. There are other very hot markets. Do you see any of those as bubbles? Or is it just simply a result of the fact, as you say, here in the Triangle, we have very low supply, and so it's just simply a case of the demand for those homes? But do you see, are there any, this market or any other markets that you see as maybe being outliers and potential bubbles, or is it just a function of the environment we're in?
So, obviously, a bubble is difficult to identify. If I, knew it was a bubble, I would be a much richer person, for sure. But I don't. So mostly, I think it's about fundamentals, unfortunately. I talk to my neighbors all the time about housing prices and how to maintain affordability in Durham and where I live. But also, this speaks for the whole Triangle area. The fundamental level is there's just a lot of demand to live in this area. It is a lovely place to live, as we all know, and more people are realizing that every day. You couple that with the fact that supply is quite low. We haven't built. Now Raleigh is doing, and all of the areas are doing a great job. I don't know if you've seen, but home building is like, I think Raleigh's number 2 in the country relative to Austin, which is one of the things we would need for house prices to moderate, house price growth to moderate. But, the interest rates going up are not going to help, because another feature of that is, like, take for me, for example, I purchased in 2019 and my interest rate is below 3%. It would take a lot for me to be willing to sell my house and move, because there's just no way I can move to a comparable house without paying much more, because my mortgage payment will be much more. So I expect actually new inventories are going to remain low for this reason for a while as interest rates are high. So I don't think the Triangle is a bubble. If anything is a bubble, and there is I do think, there's a lot of interest in like these short-term rental markets and things like that, and these vacation areas, maybe along the coast of North Carolina. I don't know too much about it, but there seems to be a lot of like institutional money and people rushing in to want to run an Airbnb. Maybe there's a little bit of without thinking through all the costs of, running basically a rental service. It's actually quite complicated, or the regulatory risk. But here in the Triangle for regular single family homes, I don't think it's a bubble. I expect house prices to keep going up at least a moderate clip. And it's just because there's just a lot of underlying demand to live here, and there's not enough supply right now, particularly in the downtown, neighborhood areas. We're seeing most of the supply, not surprisingly, in the areas where land is cheaper in the peripheries. But for these like living near your jobs and, because traffic is going to get worse, I just think that kind of demand is going to increase at least for the next few years.
Sure, absolutely. Thank you. And before we move on from the housing, there's one more question I wanted to ask about that, so I'll stay with you here. In these hot housing markets like the Triangle, we're obviously seeing rent continue to increase, which is also serving to kind of push people who aren't able to afford to buy out of the periphery. Do you think that rent is going to continue to spiral along with house prices in this area and in other comparable areas? Or are there other reasons why rent increases may cool off more quickly than house prices have?
So, I do think rents are going to keep going up. Again, there's record low vacancy rates in multifamily housing. The good news is that there's a ton of new housing starts in multifamily housing. So I think at least at the new market rate level, which is expensive, there is going to be some moderation because throughout the Triangle, there's just a ton of new supply going to be coming on market in the next few years. But till then, I do think the rents are going to stay pretty elevated because, again, there's just a lot of younger people, particularly a lot of people who are moving here, and many people are renting.
Sure, absolutely. Thank you. Professor Fullenkamp, come back to you. We had a briefing on this topic in November, and before we were kind of officially seeing this inflationary environment. And one of the points you made then was that companies were struggling to keep up with demand because they needed to build capacity, and that was what was driving price increases. Are you starting to see across the economy that companies are starting to respond to that increase in demand, or is that something that takes much longer than 6 months to actually see, and it moves at a much more incremental level? And what kind of effect do you think companies building out capacity to address the demand can help slow the price increases that we've seen?
So I don't think I've seen a whole lot of adjustment to demand in terms of building new capacity. What we've really seen in the past few months is the consequence of the shift from a pandemic world to a post-pandemic world. And that's where you've really seen a lot of activity because a lot of retailers especially misjudged the end of the pandemic and its effects and have been stuck with a lot of excess materials, goods that they really can't sell. And they have questions about what they're going to do with it. Some are thinking about maybe holding on to it and trying to sell it later at a better price. And some are thinking about trying to discount and get rid of it. Unfortunately, we haven't seen a lot of capacity building in this country, partly because our supply chains are global these days, and so we're really still very, very dependent on supply chains, especially in Southeast Asia. Now, there have been some supply chain movements to different countries and outside of China, especially, but really we haven't seen a lot of supply chain building that's really had a direct market impact here. Now, of course, there have been some really interesting announcements like the semiconductors and some of the automobile assemblies that are being promised now in parts of the U.S., but we're just at the beginning of that.
Sure, absolutely. Thank you. Professor Raziel, coming back to you, we had a question come in about, there have been a lot of headlines about gas companies and grocery companies seeing record profits. And we're being asked, how should we interpret that at a time when, as consumers, we're all feeling the pinch and there's some understandable resentment when you see corporations that seem to be kind of benefiting from this environment? Is it more complicated than that? How should we interpret those kind of numbers?
So it probably is more complicated than that, but one of the key features is whether the item that the company is selling is considered a necessity, we just have to have it, versus whether consumers have a choice whether to buy it. So, for example, we mentioned earlier that house prices have the food prices have shown tremendous increases. What's interesting, though, is that it's food prices for food at home, not food prices for food at restaurants. So the big distinction there is restaurants, their input costs, the food that they're buying with which to cook our delightful meal, they can only pass some of that cost on to us, because if they push their prices up too much, we simply won't go to restaurants. On the other hand, on the grocery store side, we have to consume food. We have no choice. We need to buy that milk and eggs and bread. So grocery store companies are more able to push some of those price increases onto us than, say, restaurants are able to. But beyond that, there are other complexities that affect this. But yes, at the bottom line, it comes down to, is this a product that we have choice whether we buy it or not? Or is it something that we absolutely need? And the more we need it, the more input price increases can be passed on to us, the customers. But don't get me wrong, the grocery companies are having to pay more for the goods that they're putting on the shelves. So I think there's some exaggeration going on there that they're truly making huge profits on the back of massive increased prices for us.
So is it possible then that people are seeing that their revenue is increasing because their prices are up, but maybe the profits aren't increasing so much because, of course, they've got output costs as well?
Yeah, I haven't actually studied that particular factor, but what you just suggested there always makes a ton of sense. Gotcha.
Thank you.
If I can jump in for a minute on that,
Please.
I think one of the things that is really complicating the issue is that if I'm a retailer, one sure way to make my customers unhappy is to do a lot of frequent price increases. So what retailers in many cases are trying to do is they're trying to moderate the number of price increases. They're going to try to increase prices once and then come back to it, in a few months rather than doing it, this week and then next week. So if you're in that kind of a situation where you're trying to, pass on some costs, but also trying to hold the line on the number of price increases, you're in a real guessing game. So you're going to have to try to guess how high you can raise the price right now and then stick to that price for a while. And so I think part of what we're seeing is that some of our retailers are trying to play that game by increasing prices enough to cover their costs now, which means that profits are going to be higher, but then sticking to those prices hopefully for a while, which means that their input prices are going to catch up and the profits are going to fall. So I think that's a little bit of what's going on as well. People just really outside of a couple of markets like the market for gasoline, where you're kind of used to seeing prices fluctuate on a day-to-day basis, really when people see prices fluctuate a lot at the grocery store or at the clothing store, that really irritates them. And that's a good way to lose customers as a retailer.
Sure, absolutely. Thank you very much. And Professor Fullenkamp, we'll stay with you. Again, when we talked in November, the Omicron wave of COVID was just hitting, and that was affecting the economy. We know from our colleagues at Duke Health that they continue to expect to see waves of COVID, but hopefully with less fatality, less severe illness. But based on what we've learned over the last 2 years, if we see continual, occasional softer shutdowns of in various cities across the country and the world, what would you expect to have that any influence over the inflationary environment when we see the occasional kind of tightenings of supply in the economy? Or is it something that largely economically we're starting to adjust to where it won't have kind of more widespread effects?
Yeah, that's a really fascinating question, because there really are two components. One is that if you think that there's always going to be a number of workers who are out because of things like health concerns due to COVID, it's going to permanently raise the price level. And so that'll be kind of a one-time shock that raises everybody's cost level a little bit. But as you suggest, in certain industries, it could cause bottlenecks of production, unfortunately, like the ones we've seen this spring with infant formula, right? So if suddenly, all the workers at a certain factory making infant formula get sick and can't be in there, they have to cut back on production, and that's going to cause some supply bottlenecks. So I think we're going to see a little bit of both. We'll see this kind of general increase in prices from, dealing with the fact that on any given day, a certain fraction of the workforce is out of, it can't come in, but also we'll see, certain unlucky industries get hit by this that can't react to these sudden changes in their labor force, and we may see some bottlenecks here and there. It'll become more common.
Absolutely. Thank you. Professor Berger, I'd like to come back to you. We've got a number of questions here about the labor market, and so I'd like to get everybody's perspective on that. But Professor Berger, we'll start with you. One of the things we're seeing, obviously, is a call for wage increases across the economy to help consumers cope with increased prices that they're seeing. Do you expect to see widespread wage increases, given that obviously the corporations and institutions that are paying the wages are also facing higher costs? And what could some of the effects be of continued pressure on employers to increase wages in this current environment?
Great question. So as Professor Fullenkamp mentioned earlier, unemployment rates are quite low still. So I mean, if you look at measures of job tightness, number of people like switching jobs, quits, they're still quite high. So I think it's still in many labor markets, particularly like, hospitality and retail, very difficult to hire people. And so I would expect to see wage increases. I think that's also wonderful for the workers, but also of concern to the Fed, because one of the concerns is that these higher prices are then sort of translated into wage increases, which then, every wage increase for a worker is now, a worker who works for another firm, that's a cost increase for the firm, right? And so then the firm has to raise prices again. So we get to kind of these wage price spirals. So that's what the Fed is trying to get ahead of. But I would agree are that I would expect to see, since labor markets are quite tight, you to see increased wages for many workers. But I think as interest rates go up and the economy starts to cool down, that is going to moderate a little bit.
Sure, thank you. Professor Raziel, following up on that, Professor Berger just mentioned, we've had this kind of great resignation, as it's been called. Would you expect this current environment to slow that down and for the employment market to settle somewhat?
Yes, I agree. I agree with what David was saying. If unemployment does start to go up a little bit, which is, sort of a feature of most recessions, while none of us want to see lots of people out of work, that will sort of have a secondary benefit of slowing down the need for wages to go up, which means that slows down the need for companies who are paying those higher wages to have to raise their own prices. So that actually, a little bit of increased unemployment actually does help stabilize prices. We may not like the way it does it, but that does help. So that would actually be a benefit if we're able to have a relatively soft recession. That will help bring inflation down a little bit.
Absolutely, thank you. And staying on that topic, there have been some calls that people should accept less wages to help the economy. We've seen here and there. Is that, what kind of fuels that kind of suggestion, and is it at all realistic?
And I think from most perspectives, that's a really nice theoretical concept that would be incredibly hard to put into practice, because every person's view about how much of that reduction should really apply to them will be completely different. So I don't think this is, not something that we typically do in this country. It's not something that your average person, that any of us knows how to think about. How do you manage those wage drops? So, and also, there's a huge unfairness component, because even if we were to do that, that does not mean prices would come down tomorrow. So then you'd be asking people to take a smaller take-home pay while still paying these higher prices. It's just really, really hard to make that work.
And if I could jump in, implicitly,
Please.
Inflation is going to do this anyway, but for everyone, So, none of us take a wage cut, but if prices keep going up, the real cost of buying stuff has gone up for everyone. So I agree with, it's a kind of nice idea, but it's just impractical to execute in any kind of real way.
Yeah, and I think there's also a really important fairness component to that, right? We know as economists that families at the low end of the income distribution actually feel the inflation even worse, because they spend a higher proportion of their income on gas and groceries, on the things that are going up most in price. So, by asking people to forego wage increases, I think that's just asking for more inequality in the economy. And I just think it may be well-intentioned, but it's a bad idea. I think we need to get back to what Professor Berger was saying, is that we really just need to interrupt that wage price spiral, really prevent it from getting going in the economy, and that will really do the most good for everybody.
Absolutely, thank you. Professor Fullenkamp, I'll stay with you for a moment, and also interested in other people's takes on this. Obviously, it's a fool's errand to suggest that we can depoliticize anything, but we see, particularly in the example of gas prices, when gas prices are low, political leaders want to take credit for it, and when gas prices are high, they want to blame whoever's in office for it. Realistically, how much power do people in office have to influence this stuff? And should we kind of dismiss basically any effort among politicians to either take credit for when things are good or to throw blame around when things are bad? How political can this situation truly be?
Well, I think that politicians, especially the ones in power, have a little bit of influence over things like production in the economy, especially in terms of things like energy, especially because a lot of the energy resources are located on federal government property. And so things like oil drilling leases and things like that are under the control of the government. So the political system can be important for certain types of resources. And these days, when a lot of the price pressure is coming from natural resources, that can be very important. At the same time, the power of kind of moral suasion. Politicians are people who are voicing the concerns of their constituents and trying to put pressure on businesses to do the right thing and to kind of listen to the will of what people want. We've seen in many cases that corporations are sensitive to public pressure. So I see it as part of the game, part of putting pressure on companies to change their ways and to change their production. For example, one of the reasons why oil prices remain high in the U.S. is because the shareholders are putting a lot of pressure on oil companies to maintain, big dividend payments and big payouts to the shareholders. And that's one of the reasons why drilling has not gone up very much in this country, especially on the fracking side. So, by putting some countervailing pressure coming from politicians, that might help to mitigate some of the pressure that's coming from shareholders that we've seen to restrain the oil drilling.
Sure, absolutely. Thank you. Professor Berger, one of the things, that we've seen ongoing in this economy over the last few decades is continuing wage inequality, income inequality, CEOs making insane amounts of money. Is there something that's fundamentally broken in our capitalist economy, that we are in maybe even a slow death spiral, the kind of end of an empire type situation? Or are these just kind of blips and waves that economies must fight, and there's nothing necessarily inevitable about oncoming doom? I realize that's rather a large question.
That is a large question. I might have to take another sip of coffee.
Sorry, I know economists don't crystal ball questions, and it's a big one.
So it's a great question. I think it's important to distinguish between before tax and after tax inequality. I mean, my personal view, we could make policy preferences for after tax inequality. The U.S. has a progressive tax system, which means that as your income goes up, you tend to you pay a higher marginal tax rate. You pay higher taxes. Now, we try to balance that with the fact that we're concerned that by raising taxes at the highest end, that might deter people from creating new companies, working more, because, you only, if you're being taxed at 100%, that means every extra dollar you earn goes back to the government. Obviously, that deters you from wanting to do it. Now, we're not that high at all. My personal view is that there's a lot of economists out there who think that we could have higher progressive taxation, and that would actually lower inequality in the United States. So that is certainly a debate we could have. I think an interesting feature about the United States is that, this is a place which is one of the best places to open a company, to become rich, people move here all of the time. It's the land of opportunity. And that's more about before tax inequality. And there's been interesting research recently in the last couple of years looking at who are the 1%. One view would be that they're all kind of like rentiers, they're inherited people who inherited their money. They're not great at their jobs. Another view would be they're productive entrepreneurs or people who run successful companies. And surprisingly, or not, I guess not surprisingly to some people, the New York Times just reported on this work. It looks like most of these capitalists actually are quite successful. So in the sense of when the owner leaves or dies, the company becomes much less successful. So it seems as if these people are actually doing something productive and creating a lot of the wealth. So I personally don't think the U.S. is in a capitalist death spiral. I think there's a very important debate to have about the level of inequality we're having. And I think the right way to do it is through government interventions. We could talk about things like the minimum wage increases. We could talk about more progressive taxation. That's the way that I would think about solving those issues.
Can I jump in with one more thing on that question, which I agree with David, it's an incredibly knotty and complicated question. But when we talk about inequality like that, it's also important to look at the level of people's quality of life and how that has changed over time. So if you do look back even just over the last 50 years, certainly over the last 100 years, the US, we talk about it as a place of opportunity, and it is a place of opportunity. And even at the lower end, we still see better quality of life for pretty much everybody than we saw 50 years ago, way more than we saw 100 years ago. That as that quality of life for everybody goes up at least some, that's actually something to feel good about. And some of that can be positively attributed to the fact that we have a capitalist economy.
For sure. I should say, I wanted to add one more thing, which is that, but it is true, though, that, though I think many people have a sense that the U.S. is less of a land of opportunity than it used to be. And there is some data that kind of suggests that. If you look at the probability that your child will earn more than you, and that has gone down a lot since the 1950s. And so I think there's a lot of work to do. And there's a lot of geospatial variation. I mean, the Triangle is actually one of the really, exemplary places to be, if you're lucky enough to be born here, because they're so good public schools and, all these universities around and so forth. But I think there's a lot more policy tools that we could be doing. But yes, I don't think that we're in a death spell for a capitalist system. I mean, yeah. So.
Well, I would echo what Professor Berger was saying. The important thing that really seems to matter to people is their perceived opportunity. They really think that they can make it. Are there real opportunities for everybody in the economy? That's really where we need to focus. I think that to a certain extent, these wage discrepancies that you hear about between CEOs and people who work for the company are really just kind of a sideshow. The question is, how likely is it for somebody who is coming from nothing to become a CEO or to become successful in some other respect? That's really what we need to focus on. And as Professor Berger said, there's some troubling signs that our mobility, our social mobility, is decreasing over time. We really need to take that seriously and think about things that we can do about it, particularly things like education, but there are many other things as well. So it's a really complicated problem and issue, but it is definitely one we need to take seriously. But again, the focus should be about opportunity, not as much on outcomes.
Completely agree.
Absolutely. Thank you to all three of you for being willing to tackle the capitalism death spiral question, which I must admit I just kind of threw out there without a great deal of preparation. Anyway, we are going to wrap up here in a moment. So from zooming way out, as I just did, I'd like to just zoom back in and ask each of you for any particular markers that you'll be paying particularly close attention to as the year wears on, things that people could look at as they're trying, as amateurs, to kind of measure kind of where the economy is going. And I realize it's very simplistic to say look at one thing because there are multiple things you look at, but any particular thing or things that you think people should be paying particularly close attention to in the economy as the year wears on. And Professor Raziel, if you don't mind, we'll start with you.
So honestly, because the two big things that the Fed, that the US government focuses on are levels of inflation and levels of unemployment. Those are also the things that I would be watching because those are the things that are going to drive Fed monetary policy. But drilling down just a little bit on the inflation piece, there are two measures of inflation that we look at. And one is what we call CPI overall inflation, which includes these highly volatile food and gas prices. And then there's something called core inflation. And that's the number that does not include the highly volatile gas and food prices. Now, clearly, it's still hurting us in our pocket if food and gas prices stay really high. But I think for a better sense of the direction of inflation, if you look at the core CPI number, the number that doesn't include food and energy prices, you might get a better sense of which direction the economy is going and which direction inflation is going.
Absolutely, thank you. Professor Fullenkamp, I realize you might just be echoing these important markers that Professor Raziel's already mentioned, but please, whatever you have to add to that.
The one thing I'm going to be looking at is related to inflation, but it's actually inflation expectations. So there are lots of different measures. Some come from surveys and some come from the financial markets. But I'm going to be really paying close attention to where expected inflation is heading, because that is really going to dictate how much harder the Fed is going to have to push on interest rates. Because as Professor Berger suggested, their big task is to interrupt this wage price spiral. And one of the things you've got to do is you've got to keep inflation expectations low and get them to come back down. And they've been rising recently, which is bad news for the economy. So I'm going to be paying very close attention. If the Fed's policies are working, if the economy is really cooling down, then we'll start to see inflation expectations also start to come down. That would be good news.
Absolutely, thank you. And Professor Berger, feel free to take another sip of coffee, but final thought to you.
Yeah, so in terms of like the Fed's ability to sort of execute a soft landing and not put the economy in a recession, the sort of the sleeper statistic that I'll be looking at is like, how often are people quitting this sort of job-to-job transition rate, the EDE rate? Because, the way people mostly get raises is moving from one company, I move from Duke to UNC or vice versa. And obviously, when people start to get concerned that the economy is slowing down, it's harder to find a new job, they're less willing to quit. So this kind of quit rate is a key indicator of how individuals see on the ground how the labor market is doing. So I think that's something that's sort of a good measure of sort of the relative bargaining power between workers and firms that I will be looking at. And then just to reiterate what the others have said, I think looking at these forward-looking expectations, so what the 10-year Treasury rate is, I think there's a lot of the 10-year Treasury rate is very close to what the mortgage rate is, plus a little bit. There's a little bit of premium. And right now it's a little all over the place because, it's the market trying to forecast what's going to happen in 10 years. Okay. So on the one hand, interest rates are going up. But on the other hand, maybe the Fed's going to overshoot a little bit. We're going to go into recession and they're going to lower rates. So I think that's going to give you a little bit of a sense of what the market thinks where the economy is going.
Absolutely. Thank you. I think that's the perfect note at which to call it. Thank you, everyone, for joining us. Thanks to our panelists, David Berger, Conal Fullenkemp, and Emma Raziel, for sharing your expertise. This has been a fascinating discussion. I've certainly learned a lot. Next week, we'll be discussing the ongoing crisis in adolescent mental health, which is quite a left turn. But if you would like to be notified about that and other upcoming Duke media briefings, please email Duke News at duke.edu, or if you're watching on YouTube, just like and subscribe. Thank you, everyone, for joining us, and please have a great day. Thank you.